Good afternoon. This is Jim Barlow with OakTree Premium Finance. I hope everyone had a great Labor Day. I went fishing with a son of mine and a grandson and two son-in-laws. We went up to Yost in the northwest corner to catch some Yellowstone cutthroats. If you haven't heard of the Cutthroat Slam, Utah Cutthroat Slam, be happy to tell you about it. Kind of fun. Anyway, I try to teach people and give this forum a week. I'm trying to do it weekly. Won't always be able to, but to explain to you how you can take life insurance and turn it into something very powerful. I'll show you the numbers and hope you enjoy the presentation. For centuries, alchemists sought to transform lead into gold, unlocking wealth and enlightenment. Well, I'm the alchemist of leverage. I'm going to show you how life insurance can be transformed to a powerful wealth building tool. By the end, you'll have the tools to explore this strategy and become a modern alchemist yourself. Welcome to the new alchemy of wealth creation. I'm married to Barbara Halls. We've been blessed with 7 children, 28 grandchildren. I graduated from BYU, where we remain devoted fans. They won last week. I worked as an investment advisor for 35 years. We love to travel. We love to visit loved ones. We enjoy family vacations. We read, we attend plays, we treasure time with family. We serve in the temple, and we strive to be disciples of Jesus Christ. Above all, I just want to do good. I want to help people where I can. I don't think it's an age thing. I want to help. Next week, we're going to New York to see 8 plays with our granddaughter, who's going to school in New York City. Anyway, there's a little bit about us. There's a picture from our reunion last summer. We do a reunion every other summer. Not this summer. Let me tell you about a real alchemist, Johann Friedrich Bodger. He was a young German chemist, and one day he showed his boss, he was an apprentice at the time, how he could turn lead into gold. It was really just a trick, but he did a great job, and there was noise around that he could do it. He was an alchemist. August the Strong, the ruler of Saxony, imprisoned him, hoping to fund his entire empire through alchemy. And so, for under arrest, he worked to experiment, to refine heat, blending materials, testing clays, trying to turn something into gold. This is a fun story. It was written, this book, The Arcanum, The Extraordinary True Story of an Invention of European Porcelain by Janet Gleason. Good book. In 1708, along with a scientist, Enfried von, I can't say his name. Someone will have to teach me. Anyway, they discovered how to get hard paste porcelain, a secret only the Chinese possessed at that time. This was really pretty cool, and the Meissen Porcelain Manufacturing Company was founded. Beautiful porcelain. You know, sometimes when you're trying to turn lead into gold, you find something else. It might be even better. Anyway, there's a little story about an alchemist. There's a lot of alchemy happening today. A lot. The internet, smartphones, cloud storage. I can't. A ChatGPT, self-driving cars. Um, uh, biotechnology, things are happening. We're finding cures for things. There's quantum computing. There's space exploration. There's some of the alchemists of today, and there's more. There's a lot of fun things happening in this world. And I'm going to show you how we can take the ordinary life insurance and really put it on its head and have it do something amazing. We're going to blend life insurance with a growth strategy and leverage into a powerful alchemized approach. You'll see the numbers. A company in Plano, Texas, NIW, they came up with this idea. They keep working to improve it, make it better. They gave it a name of Kaizen. Kaizen is a Japanese term meaning continuous improvement, meaning there has to be a better way. And their tagline is more money, more protection, more confidence. This is the alchemy I'll be showing you, Kaizen. This strategy will give you more retirement income with less out of pocket. Just that is pretty amazing. It's going to give you tax-free retirement income, tax-free, no downside market risk. Top three are pretty big. Protection and living benefits. You're going to also get long-term care benefits. You're going to get disability benefits, the life insurance part, and the living benefits part, and the top three above it, with minimal financial disruption, 5 years of payments. Simple, low-maintenance design, creditor protection. It can be used as a gifting mechanism, which some of my clients have. It's amazing in that way. You can use it for executive benefits, retention solutions for your company. You can do it to accumulate more for succession planning support or just legacy planning, all with minimal risk. Remember that third one down, no downside market risk. Well, my role, my job, my mission is to educate, challenge conventional thinking, and empower you to use this strategy to its fullest potential. There is an age range. You can't buy it if you're less than 18. And you can't buy it if you're over 65. You have to be insurable health. You need to have the financial strength to do it, to make payments over in just 5 years. And you need to be committed. A lot of investments are long-term investments, so this is too. So let's go into these three sections. Let me show you the deep information about life insurance. Obviously, life insurance provides a death benefit, but many people maybe don't know about the living benefits of life insurance. They came about in 1980. They haven't been around forever, but you can get a portion of your death benefit for terminal illness, for chronic illness, for critical illness, and even long-term care. Long-term care. You have coverage in those areas. And then the tax advantages. The Revenue Act of 1913, this is the act where the government introduced income taxes. And life insurance death benefits were deemed tax-free at that point, and it has been ever since. cash value grows tax deferred. So you're not paying taxes as it grows. And you can even use it today. You don't have to die to use these assets. You can borrow for the policy. I'll show you the details of that. Last, there is insurance costs, whole and universal life policies, but they don't have an investment advisory fees. They don't have the fee that I charge for 35 years, and very minimal management fees. Your cost other than life insurance is amazing. So there's the 4 big bullet points on life insurance. And I want to just bring this up a second time. Above all, it's really protection. It's protecting your family's lifestyle, protecting if you have long-term care needs, disability needs. I put this phrase together. I never want one of my clients to end up relying on a GoFundMe page. I want them to have assets available when they need it. I'm going to have this page filled out by the end of the better say an hour. But it's going to be the summary page. And here's the summary on life insurance. Reduce financial vulnerability. You're covered. Reduce tax risk. Reduce fee-related costs. We're going to take a hypothetical person, 45 years of age. 46 is actually the average buyer of Kaizen throughout the country. Male, excellent health, non-smoker, annual income, 240,000 retirement savings, and he's willing to put into Kaizen 50,000 annually for 5 years. The national average for that 46-year-old is 70,000, so this is even lower than the average. And he wants to start getting a retirement income at 65 and wants to make sure it pays out through 95 for sure. Here's our things we're going to go with. Illustration growth rate, 6.45. That was accurate as of July 3rd, and it hasn't changed. This is regulated by the NAIC, National Association of Insurance Commissioners, not a federal government. This is an association of states. And they say, here's the highest you can illustrate this policy. We're going to show an income tax rate of 37%, a long-term capital gain rate of 20, and a state income tax an average of 5.5. And here's our first numbers. Let me back up. If we took 50,000 a year into a regular investment for 5 years, and then we turn on an income at age 65, at this rate of return, you could pull out $37,699 per year from 65 to 95, or $1,168,659. If you did it by tax deferral, IRA, 401k, you could pull out $47,842, $10,000 more. That is alchemy. Trying to figure out a way to get more money out of something. And the total would have been $1,483,000. We're going to fill this page out before we finish today. So we covered life insurance, the growth strategy. 1997, a new type of policy was introduced called Index Universal Life. Probably you've heard of it. The big deal here is the cash value grows in the insurer's account with index options provided potential gains without downside market risk. Can't have a negative return. subject to caps and participation rates. Let me explain that. And we'll give you an example on the next 2 pages. But let's say you go into the Standard & Poor's 500 index as an investment option. No downside. If the market's negative 40%, you get 0, but you also have a cap. And in this index, right now in most companies, it's about 12.5. So that's the upside limitation. They also have participation funds. These are a more conservative. These will usually be more conservative funds. They're more balanced. And here, they don't have caps. They have a participation rate, and it's not 90% of the return. It's right now it's about 225%. So you can get 200% of a conservative index with no downside. And this is turnkey, minimal management, typically just annual decisions. You don't need to worry about whether the market is going down or up. Let me show you how they do this. I think this is important. Let's say beyond the insurance costs, you're putting in $1,000 into the cash value account of the index policy. Well, about $952 will go into their bond, their general account of their big pool of bonds, government, corporate, high quality bonds. And they know that $952 in a 5% interest market is going to grow to $1,000 a year from now. So that's how come we have no downside. Most of it's in bonds. Then we have a budget to buy options. In this example, $48. Here's where you buy the an index, options on the index to get the stock market return with a cap or a participation rate. Pretty conservative, very sound. If the interest rate environment is higher, 15%, then you have actually more money to go into the option budget. And you have higher caps, higher participation rates. But you can, I believe you can probably see how your principal is protected and safe, that you can have no downside. Pretty cool. So here's the growth. We use Index Universal Life, reduce downside market risk. There is none. Market linked performance, in some case, high participation, and flexibility, reduce future liquidity and accessibility risk. So there we have the first two, and now we're going to go into the leverage, which is a very important part too. Let me talk about mortgages for a second. Before 1934, mortgages required 1/2 down and 1/2 repaid in 5 years. I didn't know that. Well, none of us were born before 1934. My parents were. They experienced this for sure. In 1934, the FHA created the 30-year loan, which revolutionized home buying. Before 34, 40% were able to buy a home. In 2024, 66%. That's really good. 85 million residential mortgages are currently outstanding, totaling 12.6 trillion mortgages. So that's leverage, borrowing. How do we borrow? We borrow for home ownership. We borrow for real estate investments. We borrow to go into business and for investments. We borrow for education, to go to get a master's or a doctorate or whatever. Those are the positive reasons for leverage. There are leverage that are not good. Borrowing for buying a car, transportation, borrowing to pay your healthcare bills, borrowing for everyday essentials on high interest rate credit card, major life events. We see when I first used the word leverage, you thought, and borrowing, you thought, oh, that's bad. The first four are positive. And with this one, with no downside, it's even better. You know, I went with Barbara on a trip to Cabo, and we hired a photographer to walk around the beach with us and take pictures. And not all of them were really great, but I like these four. Anyway, the whole point here is, why are we not using leverage for retirement? Gee, we show you those good reasons. Well, here, let's plug in that retirement planning and asset leverage. Can we get more retirement by using leverage? And I'm saying absolutely. And that's the revolutionary, the alchemy that we're really going to do. So, banking, borrowing, leverage. We don't use 20 to 1 or anything. We use 3 to 1. We leverage structure just 3 to 1 without required traditional collateral, personal guarantees, loan documents, interest payments. It's a reasonable amount. And we, as you know, has only 5 annual payments, or with Allianz, we actually can do a monthly payment for 60 months. So short period of time of payments. And we put it together in a trust, a living trust managed by Provident Trust Group in Nevada. And here we also get creditor protection. Anyone suing you can't get at these assets. And the Provident Trust, the master trust, is getting the loan for the borrowing. They're doing all the heavy lifting. You know, there's a bunch of other stuff we do to make this thing perfect, to make it hum. And there's some of them, which I'm not going to explain to you. But if for those who are very analytical, give me a call. Happy to tell you about every one of those and how they work. So here's how the payments are. The silver pigs are your 5 annual payments. And the bank is going to put in approximately the same amount for that first 5 years. After 5 years, you're done. You're not putting any more money in. The bank is going to continue to make their 5 payments that they were paying, but they're also going to be paying what you were paying. And you can kind of visually see that 3 to 1. And without the typical risks of borrowing, no credit checks, no loan documents, no personal guarantees, no signature, no collateral. We've arranged with the bank by our structure of how we put this policy together that they accept the policy as a sole collateral, no additional anything. So we've talked about these 3. Just let me show you how it's performed from day 1. The very first policy was issued in 2012, and you get a statement on the value every year. And the June 26, 2024, on the first policy issued, it's averaged a 7.73% return per year, and its average interest that you're paying for borrowing is 3.81. So on the part that you own, the one third, you're going to get 7.73. At least this first policy has, and pay interest rate of 3.81. So it has a spread. The difference between that, what you're making and what you're paying for interest of 3.92. You're making 3.92 on other people's money. Well, maybe we won't have that situation at the high interest rates. Let me keep going. We've done a back testing to 1930. There has never been a 15-year period of time with less than a 2% spread. Yes, we get years with a market does negative 10 or something, and you would get 0. Therefore, you'd still be paying 3.81. But over a 15-year period of time, you've never averaged less than that 2% spread. 2 to 4% on borrowed money, not bad. Here's a diagram of the trust. We have the master trust I talked to you about, the Provident Life that does the borrowing. And then we put all of your policies in an individual trust. So multiple protection by trust ownerships. Okay, let's see how performance looks. I put the drum roll. This is the drum. I'm drumming drum roll, please. How did the Kaizen do? 37 was the after tax. 47 was the tax deferred. Is it going to go to 57,000? Let's move the curtain past and see where it's going to be. 90,000. Oh my lands! It wasn't 57,000. It wasn't 67,000. It wasn't 77,000. It was closer to 88. More than double the after tax. We have created some alchemy. And so your total money that you paid out at 90,000 per year through age 95 is 2,790,000. Plus, we have the initial death benefit when you're 45, and you still have a death benefit. They calculate this at 90. I'm going to see if I can get it at 95, but they still have a death benefit of 1,132,000. So you pull out 2,790,000 tax-free. Now, you're thinking this, so let's do it. What if we have a horrible world? We could. In the Great Depression, it was the worst time of all time. From 30 to 32, stocks lost 70% of their value and did not recoup their losses till 1959. Wow. Well, we did a stress test on the Great Depression where we simulated 9 years of zero over a 12-year period. Notice we didn't have a negative, we had zeros. And even with 9 zeros, this is going to work. And we stress tested for the 1980s of high interest rates. Loan rates became as high as 16.88. We've simulated that. And I'm going to show you how the simulation went. For the 1980s, it was 67,000. For the Great Depression, 58,000. Remember, I was talking about 37, 47, 57. Here's 58,000. The worst of times, we still did alchemy. And in the stress test of the 80s, another 10,000 to that. So in bad times, this has worked and will work. Now I got to tell you one more thing. Allianz did a study on these illustration numbers that Kaizen and IW put together. They wanted to discover if they're full of lies. They want to see if it's truthful. And they said, we concluded that there's an 80% chance that it won't be 90,000. It'll be double. 80% chance it'll be 180,000. Now we have really created some major alchemy from 37,000 to 180. Well, it might not be that 80% chance, but 90,000 is going to be happy with me, or Depression era or whatever, or 180,000. Wow. Pretty protected on the downside. So there's our summary page. The banking, we put substantially reduced capital outlay. Reduce payment fatigue, only 5 years. Reduce liability risk, eliminated it. Reduce management complexity risk. I like it. We're about wrapping things up, but let me show you. I did this as kind of fun. In the investment world, we have what's called the 7-point risk matrix. So number 1, risk-free is FDIC insured savings. Yeah, that'd be risk-free. Or 2, low-risk government bonds. Yeah, I can see that. 6 and 7. The 7 is extreme risk, crypto, options trading, startups. So these are the, is Kaizen in the middle then? The 3, 4, or 5? Where is it in the middle? Well, you wanted to know. It's just a tad more volatile than low risk. It's moderate to low. Same as high quality corporate bonds, annuities. So you're not taking big risk here. We've got a great tool. This is an amazing tool. We actually got 2 of them, but let me just talk about the first one first. This is a landing page. That QR code, you can pull it up, and you're going to have this landing page that has videos, explanations, illustrations. You can put some numbers in and see how it grow. Extensive, very good. From this, many people don't even call me. They just buy it. And everything's set and ready to roll. Not that tough. I hope you got that QR code. This is the place to start. We recently came out with another landing page, especially for those gifting assets to their kids. And I don't have a QR code on this yet, but I will get one. But if you're older and you really wanted to give this to your children or grandchildren, this is the landing page for you to get the knowledge you need. These 2 tools are amazing. If this is what you're interested in, this one, just text me, email me, and I'll send you the link to pull this one up. You don't have to put a social security number in. Don't have to give me your email, your phone number. You can look at these sites to your heart's content with no commitment or even me knowing that you're on it. I think my website is amazing. I have an amazing web guy that helps me, and that has a lot of things. I have a lot of quick links. I've got a retirement income gap calculator that I built. And let me just show you it real quick. This simple calculator, you put in your age, how much you think inflation will be, what your assets are, and it'll tell you what your gap is. This is saying that your desired income is $285 when you retire at whatever age, and that your current assets will give you 129, or you're short, you have a gap of 155. This is a basic calculator, simple, simple, simple. You can do it in just minutes. Here's a little more complex, but still not bad. And this has everything. I put in Social Security. If you don't want Social Security, you don't have to have it. Your 401ks, but it does basically the same thing. It helps you decide what your gap is in building for retirement. And we're done. Oh, 12:34. I'm actually getting better all the time. I like to keep it short. My goal is really 30 minutes. I said earlier an hour, but that's not true. But there's the QR code. Happy to answer questions. You can call me. You can go through the site, gain all the knowledge you want. I've got the calculators on my website. Whatever I can do be of help. I'm the Alchemist, and thanks for attending today. Goodbye, and send your friends to come watch my presentation next week. Bye.